Hey everybody, Amiee Carr with Atlantic Coast Mortgage here to talk to you about appreciation and what that means to you as a buyer. So appreciation, it's basically explained as how much value your home gets from the time you buy it each year. So in the past few years, appreciation has been out of control. So we've seen crazy amounts of appreciation. I'm talking like 10 to 20% in certain areas. It's insane. That is not normal. The normal typical market appreciation, somewhere between 3 to 4% in that range, is a normal appreciation rate. So what I want to show you today is what that means, okay? So if you're a buyer looking in the market today and you're like, man, I don't know if I should buy now or if I should wait. Let me tell you, you need to just do it now. Stop letting rates and things like that control you and give you fear about what you're doing. So we're going to take a look at a scenario here in Virginia Beach, Virginia. $400,000 purchase price, 3.5% down payment, all your closing costs, not including prepaids and escrows, about $8,500. We're going to look over a 4-year period of time. If you buy your house now at $400,000 next year with a 3.86% appreciation, you're looking at that house being worth $415,424. Every year that value is going to increase because a house is an appreciating asset. It increases in value. Okay. And 5 years from now, you're going to have $83,000 in equity there. Now, what does that actually mean in a mortgage and a number? And why am I saying that the rate part does not matter? Okay. Let's look at a scenario. If you have a 640 credit score, you're using a first-time home buyer program, FHA loan, $400,000 purchase price, rate as of today for that score, 6.5% with no points. You're not buying this down, paying money for a lower rate. Taxes, insurance, mortgage insurance, total payment, $3,265.67. Okay. Now, with that, if you wait till next year, like we just saw, you're going to pay $415,424 for that same house. Let's say rates do drop 0.5% to 6%. Your payment's going to be $32,043.15 because you're paying $15,424 more for that house. So you're really only saving $22 a month in your payment. It's not substantial to lose $15,000 in equity when you can always refinance. Let's say you waited 2 years. Now you've lost $31,000 in equity. And let's say rates went down to 5.5%. Yeah, you're saving a little bit of money, but is $47.81 a month worth losing $31,000 in equity? I don't think so. Let's just go crazy. Rates go back into the fours. They go to 4.5%. We're 5 years into waiting at this point. You're now losing $83,000 in equity because now instead of paying $400,000 for that house, you're paying $483,000 for the same exact house. Payment, almost exactly the same. It's 20 cents difference at that point. And this isn't even factoring in that taxes and insurance and everything's going to keep going up because of inflation. So I say this because you have to educate yourself. I feel like so many people are so fixated on interest rate, interest rate, interest rate. Interest rates aren't everything. You have to think long term. You have to think big picture. If this is something that you've been worried about and you want to see a personalized scenario for yourself on what something like this would look like, I would love to help you. I would love to educate you, set up a time to talk through your scenario, help you plan. Yes, in some circumstances, you have to wait. You have to work on saving up money, or we have to wait till you're at the job a certain amount of time, those kinds of things. But you don't know what you're planning for if you don't know the questions to ask. I can help you with that. So give me a call anytime. I would love to chat with you. I'll put a link to my calendar if you want to schedule a time to chat in more detail about your situation. Have a great day.